Okay, so this is the last set of notes that are going to be relevant for this week's module. So this is the part 3 exchange rate notes of 4. Uh, and the fourth set of notes, which will deal with fixed exchange rates, will be in the week 9 module. So next week we'll take this up at the start of the week, and then we'll move into the material that's in chapter 18. So where are we? So we have done, we talked about the foreign exchange market, what we mean by appreciations, depreciations. We have talked about the real exchange rate and the idea that it is the real exchange rate that, in fact, is going to tell us something about trade flows. And what we are going to do now is to think about what things drive changes in the nominal exchange rate, and then, as I said, part 4 will be next week. So where we left off in the previous set of notes was sort of a review and then looking ahead. And so we don't need to go through this all exactly, but to motivate what we're doing, what we're going to focus on are what are the things that cause the nominal exchange rate to change. And our idea here would be that as the nominal exchange rate changes, then the real exchange rate changes. As E changes, then the real exchange rate changes, and this is going to lead to changes in net exports. And again, this could be something that can drive business cycle fluctuations, as we will likely talk about in the course of the next several weeks. So to remind us of our setup, what we have in our characterization of the foreign exchange market, so FX is a common shorthand for foreign exchange market. So we have on the horizontal axis the quantity of dollars that are traded in the foreign exchange market. On the vertical axis, our price measure is the price of the dollar, where that's how we're thinking about the nominal exchange rate, and we're defining it as units of foreign currency per dollar. And then we have a demand curve for dollars and a supply curve for dollars. And again, harking back to what we did before, I want to suggest that even though this looks potentially weird, this is not unlike, again, the quantity of dog food, or if we were to think about the dog food market, we would have the demand for dog food, and we would have a supply of dog food, and we would talk about the quantity that's traded on the horizontal axis, and we would have a price of dog food on the vertical axis. So here we have a price of dollars because it's dollars that are being traded. And what is the price of dog food? Well, it's some other thing you can get in exchange. So say dollars per pound of dog food. And here we have, say, units of foreign currency like maybe yen per dollar or pounds per dollar, whatever. So just as in the market for dog food, we would think about there being sort of an equilibrium price, and we would note that as the demand curve or the supply curve shift around, then there would be a different equilibrium price. We're going to do exactly the same thing here. So for instance, in the foreign exchange market, all other things equal, meaning holding fixed the supply curve of dollars, anything that shifts the demand curve for dollars rightward is going to lead to an appreciation of the dollar relative to the foreign currency. So for instance, what would be our picture? It's just like the stuff that we did in the first part of the semester. If the demand for dollars shifts from D1, or excuse me, D0 to D1, then what do we observe? We observe that The initial equilibrium exchange rate can't be the equilibrium exchange rate any longer because there is a shortage of dollars. That shortage is going to put upward pressure on the price. As the price of dollars rises, we will talk about an adjustment along the demand and the supply curve for dollars. That would imply a higher equilibrium price of the dollar. So if this was like, oh, I don't know, 4,000 yen per dollar, then this would be 7,000 yen per dollar, for example. So why would there be an increase in the demand for dollars? Well, this forces us to go back and remember what is lying behind the demand and the supply curve. Dollars are demanded in the foreign exchange market. So we can say dollars are demanded in the market in order to purchase, say, US or dollar denominated, so things in dollar prices, goods, services, and financial assets, including, like foreign direct investment, loans, stocks and bonds. So the demand for dollars is going to rise if there's a higher demand for goods and services. In other words, if there's an increase in exports of what? Of goods and services from the US to the rest of the world. And the demand for dollars would also rise if there's a higher demand for US financial assets. By whom? By people in the rest of the world. So the rest of the world wants to more intensely buy, say, stocks or bonds in the US. Similarly, just to be as precise as we can, all else equal, so in other words, the demand for dollars is unchanged. If we have a leftward shift in the supply curve for dollars, so in other words, if the supply curve for dollars were to shift from S0 to S1, then we would again predict that the dollar would appreciate in the foreign exchange market, because again we would observe that following the leftward shift in the supply curve of dollars at the original equilibrium exchange rate, so suppose this is I don't know, £1 per dollar, we have a situation in which the quantity supplied of dollars is less than the quantity demanded of dollars. That shortage of dollars would put upward pressure on the price in the foreign exchange market, and the price is the exchange rate, the price of the dollar. So we would predict that the dollar would rise, say from E0 to E1. So maybe this is 1.25 pound per dollar. So that would be an example of the dollar appreciating relative to the pound because every dollar is going to be able to acquire more pounds, formerly one, and at E1, 1.25. So again, why would the supply curve for dollars shift? Well, again, we need to remember that dollars are supplied in the foreign exchange market in order to acquire foreign currency, and suppliers are supplying dollars to acquire foreign currency in order to purchase foreign currency denominated goods or services or financial assets. So dollars are supplied in order to acquire foreign currency to purchase foreign currency, carry it over here, denominated goods, services, and financial assets. And so by foreign currency denominated, what I just mean is that if you want to buy sake in Japan, you're going to need to get some yen. If you want to buy a spiffy umbrella in London, you're going to need to come up with pounds. So we need to supply dollars in the foreign exchange market in order to acquire the foreign currency to purchase foreign currency denominated goods and services. So flipping that around, the supply of dollars would fall in the foreign exchange market if there's a lower demand by people in the US for the rest of the world's goods or services. So in other words, if imports by the US from the rest of the world, so imports of goods and services by the US from the rest of the world would be going down, then there would be a smaller need to be supplying dollars in the foreign exchange market. Similarly, if dollar holders don't want to buy as many financial assets from the rest of the world, then that would also correlate with a smaller supply of dollars. So with that, what we can do is summarize and then move on. So what's our summary? Our summary is that if the demand for dollars is our summary is that the demand for dollars is changing when the rest of the world changes its desire for U.S. goods or services or financial assets. So if the rest of the world wants more of U.S. stuff, then the demand for dollars is going to rise and vice versa. And the supply of dollars is going to change when the US changes its desire for the rest of the world's goods and services and financial assets. So if the US wants more of the rest of the world's stuff, then the supply of dollars is going to go up. If the US wants less of the rest of the world's stuff, then the supply of dollars is going to go down. Now, to lead us to the big payola screen or slide that happens next, what I want to do is just make an observation. So some of these decisions about whose goods or services or financial assets am I going to buy are going to be relative. So by relative, what I mean is, do I buy a good or service or financial asset from the US or from another country? And so as such, there are going to be some exchange rate determinants or shifters that are only going to affect the demand for dollars or only going to affect the supply of dollars. But there are some instances in which the exchange rate is going to be determined by changes in relative macroeconomic variables. And in those instances, both the demand and the supply curve for a country's currency are going to change. And so that leads me to the next slide. I found the discussion of this in chapter 16 to be kind of wordy and a little overwhelming. And so what I tried to do is boil it down into one quick stop shop. Now, let me say that this is the complete summary of things that I could ever ask you about the foreign exchange market and shifts in demand and supply curves. So if say for a quiz that you want, you might want to remember, oh, I need to go to slide 8 from this set of notes. So what am I saying here? What I am saying is that if we look just at column 1 for a second, there are some things that in the foreign exchange market we would surmise would only shift the demand for dollars because it's only going to affect the rest of the world's demand for dollar denominated goods or services or financial assets. So what might those things be, and what are my crazy plus and minus signs? So what my plus and minus signs here are to describe is along these lines. So if it is the case that income in the rest of the world, GDP in the rest of the world goes up, then I would predict that the demand for dollars would go up. And what would be the logic for that? Well, the logic would be that if people in the rest of the world have higher incomes, then they're going to be able to and want to buy more stuff. Some of that stuff is going to come from the US, and in order to acquire US stuff, they need to have more dollars. So the demand for dollars would go up. Another thing that could potentially shift the demand curve for dollars, but would have an inverse relationship, would be trade barriers that are levied by the rest of the world against the United States. So the minus sign here is to say if these trade barriers are relaxed, so if we get to freer trade, so the trade barriers themselves go down, then this would be something also that would increase the demand for dollars. And the logic for this would be, suppose uh, Japan has tariffs in place against many of the United States' goods and services. If they relax, and so what a tariff is going to do is it imposes a tax effectively on US goods and services, makes them more expensive in Japan. If the trade barrier is removed, then what that's going to mean, but removed by Japan, is that US goods and services from the perspective of Japan are going to be cheaper. And we would predict that there would be, other things equal, a higher demand for US stuff by the citizens of Japan. And so, in order to buy the US stuff, they need to have more dollars. So, we would predict that this would lead to an increase in the demand for dollars. And then a third thing that's described in the textbook, I'll be honest, I'm probably not going to ask a question on this, but who knows, would be the degree of innovation and marketing that is done with respect to US goods and services. So by domestic here, interpret this for now as the US. So if the US develops more innovative products or markets them in a way that changes people's preferences towards having to have these US goods and services, then in order to get them, they need to have dollars, and that would be something that would be associated with an increase in the demand for dollars. And then we have the observation that we had before, all things equal, if it is the case that the demand for dollars shifts to the right, then the US dollar is going to appreciate. So that's one set of things that could drive the nominal exchange rate. A second set of things that could change the nominal exchange rate are factors that would shift only the supply curve for dollars. So, what would be some examples of these? So, one example would be income levels in the United States, GDP in the US. So, I want to get us to ultimately this box down here. So, suppose it's the case, and again, we have this. The plus sign here denotes that there's a positive relationship. So suppose that income levels in the US decline, that means that consumers are able to buy less in the way of goods and services, and that would mean that they buy less stuff from the rest of the world, and so there would be a decline in the supply of dollars in the foreign exchange market. So the plus sign here means that these arrows are going in the same direction. So conversely, if US incomes rose, then we would predict that people in the US would want to buy more stuff in general. Some of that stuff would come from abroad, and so they would need to be supplying more dollars in the foreign exchange market. Again, we have the idea of trade barriers. And just as a country abroad can levy trade barriers against the United States, of course, the United States can levy trade barriers against the rest of the world. So let's take the US. The US has raised tariffs on China for a wide variety of goods and services over the last several years. Suppose it is the case that the US decides to relax those trade barriers, then that would be something, again, if we had, well, actually, let me go the other way to be consistent with my box here. Let's suppose that we continue to raise these trade barriers. So US has increases even more its tariffs on foreign countries. In that particular case, then it makes the rest of the world stuff because a tariff is just like a tax. It raises the price of foreign goods and services. It means that there is less interest on the part of people in the US to buy those things because they're more expensive. And so that would be something that would decrease the supply of dollars in the foreign exchange market. So again, the minus sign here is to suggest that as we levy more in the way of trade barriers or we move away from free trade, then there's going to be a decline in the supply of dollars in the foreign exchange market. Similarly, suppose it was the case that innovation and marketing in the rest of the world was such that we looked at their stuff and said, meh, I don't want that. Then that would also be something that would cause the supply of dollars to decline. Or conversely, if there were some spiffy new thing that was innovative or marketed particularly well in the rest of the world, and that caused preferences in the U.S. to shift towards those particular goods, then the supply of dollars would increase. So again, we have the observation that all things other things equal, if the supply curve of dollars shift to the left, then the dollar is going to appreciate. And you can reverse this, right? If the demand curve for dollars shifts to the left, then the dollar is going to depreciate. If the supply curve shifts to the right, then the dollar is going to depreciate. Now, there are a set of variables that are going to influence both the demand and the supply of a country's currency, say the dollar, in the foreign exchange market. And so one of these would be relative real interest rates. And so what I want to do, I'm not going to draw this out for all of these cases. I'm going to talk through all of them, but I'm going to leave the drawing to you. I'm going to take this first one right now and say, let's suppose, let me draw the foreign exchange market. So this is the quantity of dollars, and this is the exchange rate, and the demand for dollars, the supply of dollars. And let's suppose that this is, say, versus the pound. So this is pounds per dollar. And let's just suppose for simplicity that we start off with 1, that the dollar-pound exchange rate is 1 for 1. Now let's suppose that we have higher interest rates in the US, and it's relative to what else could you do with your savings. So you can either save by buying US financial assets, or you can save by buying foreign financial assets. If interest rates in the US rise relative to those abroad, so this means we see an increase in US interest rates relative to abroad, or foreign interest rates like in the UK, then what does that mean? That means that US interest-bearing financial assets are now more attractive or more desirable. Why are they more desirable? Because they have a higher return attached to them, a higher interest rate attached to them. So that's going to have an effect on both the demand and the supply of the country's currency. It's going to have an effect on the demand side because people in the rest of the world are going to say, woohoo, I want those US interest bearing financial assets because their rate of return is now higher. So Now we'll have the demand for dollars shifting from D0 to D1. So the demand curve is going to shift out to the right. And why is this? This is, again, say people in the UK, want more US financial assets because their interest rate attached to them is higher. People in the US look at this and say, well, I don't want pound denominated financial assets quite as much as before because the rate of return that I can get in the US is higher. So some of these dollars that were previously supplied were supplied to acquire, say, UK financial assets. With the higher interest rate in the US, fewer of these dollars are going to be supplied for purposes of acquiring UK financial assets. So we would expect to see the supply curve for dollars shifting to the left, right? So now we get to play the fun game that we played before back in chapter 3 or 4, whatever it was. If we have an increase in the demand for anything, in this case dollars, and no change in supply, this is going to lead to a higher equilibrium price. And what is this? This is just our nominal exchange rate. And we won't worry about the quantity here because what we're interested in for purposes of discussion is what happens to the nominal exchange rate. And if we have a decrease in supply and no change in demand, that also leads to a higher equilibrium price. And what is that price? It's just the exchange rate. So both of these shifts together, for sure, are going to tell us that the dollar will appreciate relative to the pound. And we can see that here, that the new exchange rate is going to be where the blue supply and demand curves intersect. And so this might be, again, 1.25, say, pounds per dollar. So what can we conclude? And we'll come back to this at the very end of this. We can conclude that when we have higher US relative interest rates, then it's going to be the case that we would expect to see the value of the dollar appreciate. So in this column, what I'm doing, change my pen color, change my pen color for a little bit of contrast. In this column, what I'm doing is saying, suppose this what I have in the third column goes up. So suppose we have an increase in US interest rates relative to those abroad, then this is the chain of events that we just traced out. Similarly, let's suppose that we see higher prices in the US relative to those abroad. So the F again here is just telling me the foreign country. If we have higher prices in the US, then other things equal, that's going to discourage the demand for dollars because US stuff is more expensive relative to foreign. Goods and services. And so in this particular case, then people in the rest of the world would say, oh, I don't want to buy that US stuff. It's more expensive. I'm going to buy from another country. Similarly, dollar holders would say, ooh, maybe I can find this good cheaper in the rest of the world. And so would supply more dollars in the foreign exchange market. And I'll leave it to you to draw this out. And I think it would be really excellent practice if you do. But what you should be able to convince yourself of is that if the demand curve shifts to the left and the supply curve shifts to the right, both of those factors will cause the dollar to depreciate. So we have the observation that higher US relative prices, higher US relative prices lead to a depreciation of the US dollar, or the price of the dollar is going to go down. Domestic business profitability, this is somewhat similar to the idea behind interest rates, but we want to treat it as its own distinct thing. So if businesses seem to be more profitable in the US relative to in the rest of the world, then you would see people in the rest of the world saying, "Ooh, I want to get in on that. Maybe buy the stocks and bonds of those more profitable companies." And so that would cause the demand curve for dollars to go up because those U.S. stocks and bonds. So again, domestic here, I have in mind for now the U.S. Those stocks and bonds are now going to be associated with with higher potential profits. So they are denominated in dollars. People in the rest of the world would need to demand more dollars. Similarly, US, say, dollar holders would say, well, shoot, I want to park my funds in the US. I don't need to supply as many dollars in the foreign exchange market as I search for profit opportunities because US businesses have all of these really great profit forecasts. So there would be a smaller supply of dollars in the foreign exchange market. And as we just drew out in the first case, we would see that the dollar would appreciate. And that's not surprising. If people are anticipating higher domestic profits, then the currency should reflect that. Another thing that can affect exchange rates is relative political risk. So here, again, to be consistent with what I'm doing in this column, is saying suppose that the U.S. becomes relatively more risky from a political point of view. Case in point, we've seen some crazy stuff happening over the last several weeks, and some of that political risk has been reflected in currency fluctuations. So if it is the case that say the U.S. is viewed as being more risky from an institutional point of view, then there's going to be less demand for the assets, especially that are associated with the U.S. And so we would expect that then there would be a decline in the demand for dollars. So people in the rest of the world are like, ooh, the US, that looks like a scary, kind of sketchy place. I don't want to buy their goods or services or financial assets. And so the demand for dollars would go down. Similarly, people in the US, maybe in an effort to escape some of this riskiness, might be looking for safe havens in other countries. And in order to take advantage of those safe havens, they need to convert their currency to the foreign currency. So they need to be supplying more dollars. So it should come perhaps as not a surprise that when there is a higher degree of domestic riskiness, that would imply a dollar depreciation. And then finally, this is kind of fun because it shows a common thing that we see in economics, which is the idea of self-fulfilling, as we'll see, expectations. So suppose that people expect that the dollar is going to depreciate, and speculatively, so you have no current information, but speculatively just think, oh man, the dollar is going to depreciate. That's going to erode the rewards that I get for being in the U.S. And so, how might people act on those expectations? Well, expecting something in the future could lead today to people saying, nope, I don't want to buy U.S. goods or services, and especially financial assets, because I expect that their value won't be maintained. So the demand for dollars would go down. Similarly, dollar holders, say people in the U.S., who are again as well perhaps speculating that the dollar is or that the U.S. is going to experience turbulence in the future, might try to as well find sort of safe haven opportunities in another country. And so, in order to do that, they would need to supply dollars. And both of these things, as we have seen before, would contribute to a dollar depreciation. So this is interesting because what we see is that the expectation of the poor outcome, say a depreciation in the dollar, leads to that actually materializing, leads to the poor outcome happening, in fact. And this will be something that we'll see in a couple of other places, most notably at the start of next week when we talk about fixed exchange rates and speculative attacks on countries' currencies. So this represents the complete set of things that I could ever ask you about in terms of the foreign exchange market. And all that I would recommend that you do with this, since tests are open book, open notes kind of thing, is remember where you saw this, and then you will be able to with any sort of story problem I give you, go match it to what's happening in this slide, and figure out how the demand and supply curves are going to be affected, and by extension, what's going to happen to the exchange rate. So at this point, what I want to do is summarize and make 3 comments. So first of all, given that we know the shifters of the demand or the supply, or in some instances, both the demand and the supply of a country's currency, then we can predict the impact on the equilibrium nominal exchange rate. So in other words, we know what's going to happen to this. So comment number 1. Because it is the real exchange rate that is going to be driving trade flows, we know that, all other things equal, if the US dollar appreciates, if E goes up, then it's going to be the case that we see a real appreciation. And for the reasons that we talked about earlier, that's going to lead to a decline in net exports. So US stuff is going to become more expensive, foreign goods and services are going to become relatively less expensive, and net exports will go down. And if the dollar depreciates in nominal terms and there's no other change in this equation, then of course there's going to be a depreciation in real terms, and the associated impact on net exports would be for net exports to rise. So comment number 1, we now have a complementary explanation for why higher relative US real interest rates will be associated with a lower quantity of net exports. This is pertinent to Chapter 18, where we address this. Is in our earlier notes, we talked about net capital inflows and negative being the negative of net exports. And earlier, we commented that if it is the case that we see higher, say, US interest rates relative to those abroad, this would be something that would increase net capital inflows and therefore would decrease net exports. But now we have another story that is just the flip side of this, really, is just complement. And that is that if we have higher US real interest rates relative to those abroad, this is going to be something that increases the demand for dollars, decreases the supply of dollars in the foreign exchange market. This is going to lead to an appreciation of the dollar relative to foreign currencies, and this will lead to a decline in net exports because it also is going to lead to a decline, an appreciation in real terms as well. So that's kind of cool. We have just another story. And again, one of the things that we'll be doing in Chapter 18 is beginning with curves that look like this, where we have the real interest rate, and we're going to say there should be an inverse relationship between the quantity of net exports and the real interest rate. And I will not go through this again when we're in Chapter 18. I will presume that you can tap back into the reasons why. We can also now explain how net exports can be crowded out. So if you recall, our picture from earlier was that we had, say, the quantity of loanable funds, and we had a demand curve for loanable funds that told us something about investment, and we had the supply curve for loanable funds that was a reflection of national savings plus net capital investment, and national savings is is personal savings plus savings by the government. So what we talked about in that earlier discussion was the idea that if we have more expansionary fiscal policy, we could see a crowding out of consumption, of investment, and of net exports. And we could talk about why consumption and investment were crowded out through the interest rate channel, but we weren't in a position, a good position, to talk about crowding out of net exports. Again, we had to kind of work through the backdoor channel of net capital inflows. But now what we can do is we can say if we have more expansionary fiscal policy, so say an increase in government expenditures, that's going to be something that reduces savings by the government and reduces the supply of loanable funds. So if the supply curve for loanable funds shifts to the left, we would see that we would have a higher real interest rate, and should have denoted this before. Say a lower quantity, this would be the equilibrium initial quantity of loanable funds and the new one, but a lower level of investment. So we talked about this being the crowding out of investment. And we said along here is the crowding out of consumption and net exports. And we could talk about, this was in fact R star, we could talk about that crowding out, but now we can kind of just approach it from our exchange rate channel. So if it is the case that we see an increase in interest rates, and again, it has to be relative to interest rates abroad, then this is going to be something that causes the dollar to appreciate in nominal terms, lead to an increase in the dollar's value in real terms, and a decrease in net exports. And so this would be the crowding out of net exports through through this exchange rate mechanism. So that's this. So that's what I mean by this statement. So that's one comment. A second comment is one that turns on purchasing power parity. So again, we have this equation that describes the real exchange rate. And what we saw in our big table from before is that if we see higher prices in the US relative to those abroad, we would predict that the demand for dollars would go down, the supply of dollars would go up, and the dollar would depreciate. So the dollar is going to depreciate in response to the fact that goods and services in the US are more expensive relative to those abroad. Now, the question is, how much does the dollar depreciate? And so how much? Well, one thing we can say is that if purchasing power parity holds, because the real exchange rate has to be 1, so if this is 1 always, then if we have higher prices in the US relative to those abroad, then that has to be matched exactly by a depreciation in the currency in nominal terms. And so what does that mean? That means in words, what's happening is that as stuff, say in the US, is becoming more expensive, we see a depreciation in the value of the dollar that's going to fully reflect that. So if prices are twice as high in the United States, then you're going to get half as much foreign currency. And as a result of that, what's going to happen is that nominal price changes are going to fully impact nominal exchange rates and don't affect real trade flows. And that sort of makes sense as a long run proposition. All of the other things that were in that blue and white table on slide 8, we're looking at real variables, so real interest rates, real profitability, real income levels, and so forth. And we were saying changes in real variables ought to affect the real exchange rate and trade flows. But if you just have this nominal change going on, it might not. So an open question always, and this will be something that we take up also in our fixed exchange rate notes, is it the case that purchasing power parity holds? So if purchasing power parity holds, then changes in relative prices in countries won't impact trade flows. And our third comment is that, we've talked about shifting the demand and supply curve, and the exchange rate rises or falls according to what those shifts are. So, in other words, we have been assuming that the nominal exchange rate is fully flexible. Or, in other words, what we've been describing is a floating exchange rate system. And a floating exchange rate system is one in which, when the demand and supply curves shift around, then the exchange rate is going to move to equilibrate the market, or to ensure that the quantity demanded and quantity supplied of a country's currency are the same. But what if a country's nominal exchange rate is prevented from adjusting? Then this is a situation which the country has a fixed exchange rate system. And I do want to talk a little bit about this, because some of you may have countries that you're analyzing for your project that have a fixed exchange rate system. And so I want to take a little bit of time and think about, what does that mean in the context of demand and supply curves shifting around? So this will be the stuff that we turn to next, and next is in week 9. So no more for this week. In week 9, we'll begin by thinking about fixed exchange rates. And with this, we'll also be able to talk about managed exchange rates. Or sometimes, in a pejoratively negative sense, you'll hear this as referred to as a dirty float. So not a purely competitive market. So this will be stuff that we turn to. And with that, I wish you the best of luck on navigating the quizzes this weekend. And I will check in with you with fixed exchange rates at the start of week 9 next week. Thanks.